Hello everyone, this is Professor Fang. Today we are going to talk about the art and the science of finding 100 baggers. So this video is partially inspired by the book 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. By the way, I'm not a financial advisor, so this video is my personal study note and for entertainment purpose only. Whenever I say 100 baggers, you may think about the crypto. Either you gain a lot or lose a lot. Those people who get rich overnight or get rich when they are very young. So the strategy that I will share to you is quiet. It's not like overnight and it's equation based. Don't be scared about equations. I will walk you through. And it has engineering flavor, which means it's rigorous. So here is the guidance of this video. First, we will introduce the core system that helps you to find 100 baggers or exclude those ones that cannot become 100 baggers. Second, I will give you an example, a lab mouse. I'll give you an example comparing two model companies. So in this case, after you learn the theory, we use two lab mouse to do the comparison. And then third part is a take-home information. I will summarize the things that you need to take home. And the fourth, I will give you some practical guidance. So it's not only a science, but also an art in terms of finding 100 baggers. So first of all, what's the core theory? The core theory can be summarized in one single sentence, which is in the long run, shareholder returns tend to approximate the company's long-term return on invested capital. It's kind of abstract. Let me give you an illustration. So look at this equation. ROIC is actually return on invested capital. So the stock price change in the long run is approaching this ROIC. And ROIC is what? It's NOPAT divided by invested capital. NOPAT is net operating profit after tax, which is unleveraged, pure operational cash generation of the business. The denominator is invested capital, which means that you invest certain money and then how much you get in the numerator. If this ratio is high, which means this company is very efficient to turn money into more money. So that stock price in the long run will approach this ratio. Of course, this model is a simple model. We did not consider about the dividends, share repurchases, or dilution, right? So ROIC answers one simple question. For every dollar locked up in this business, how many cents of pure profits does it split out every year? ROIC is only one part of the story. The other part of the story is the reinvestment rate. So we have the following G, which is the company's annual growth rate in operating profit, which is the increase of the profit, right? It's equal to ROIC multiplies the reinvestment rate. Reinvestment rate measures the percentage of the company's after-tax operating profit that is reinvested into the business. Imagine a company has a very ROIC, but it never reinvests. So, the profit growth will be zero. So in short, a company should do two things. One is very efficient in running the money. If you invest $1, it should return you a lot of money, like 50 cents as a 50%, right? And also the company should reinvest their profit into their business so that they can compound. If you like this engineering style, hardcore analysis, please subscribe for more. So with this theory, we can go into our lab mouses, right? To compare two companies, two model companies, and then to see their performance. First of all, so the company A has expensive PE of 50, and its ROIC is 50%, and its reinvestment rate is 100%. The market cap is $1 billion. So the company B has a cheap PE, which is 10, but ROIC only 10%. And it also have a reinvestment rate of 100%, and the market cap is also $1 billion. So the company A is kind of like an expensive company already because P is 50, but ROIC is also kind of high, which company would you pick? A lot of investors tend to choose the cheaper one, which is the company B, because A and B are similar in every way except the ROIC, but the company B is 5 times cheaper because PE is only 10. But let's do the math. If you look at this model case after 10 years or 20 years, even initially, the company A has less earning because of the same market cap but a much higher PE. After 10 years, the earning of the company 1 becomes $1.15 billion. And the earning of the company B is only $259 million. If we assume the same PE at the end, the market cap for company A is already $57.7 billion, while the market cap for company B is only $2.59 billion. After 20 years, the earning of the company A is way higher than the company B. As we can see that the earning of the company A is $66.5 billion, the market cap is $3.33 trillion, while the earning of the company B is only $673 million and the market cap is only $6.73 billion. So you see the difference. The ROIC is very important, right? So if a person buys the company A, the annualized growth rate in this simple model is exactly 50%. If somebody buy a cheaper company B, it will not have like a rebounds or anything. It's cheap because of a reason, right? And the return year to year is only 10%, which is also okay, but not as good, not even close to the return of company A, even though the company A looks very expensive. So you may think, okay, after 10 years and 20 years, maybe the PE value of the company A will drop all the way from 50 to 10. Let's see, if at the end, both company PE value is 10, what will happen to the return? So if you hold 10 years and the company A PE drops to 10, the market cap will be $11.5 billion. You still have 11.5 times of increase. That translates to the annualized return of 27.7%, which is great, right? But if you look at what happens after 20 years, the PE goes to 10. That translates to the company terminal market cap of $665 billion. And the total return over that 20 years is 665 times, a massive amount. And your annualized return goes up to 38.4%. So even though the PE eventually goes to 10 for the company A, you still get a great amount of return. So don't buy cheap. Buy things that is relatively cheap. Hopefully by now you understand the power of this sentence. In the long run, the stakeholder returns tend to approximate the company's long-term return on invested capital. It's based on math, right? So the take-home information. I'm an engineering professor, so I do some derivation. So the total price multiple, I derived it for you, which is here. You can take a screenshot, right? So that's equal to, the R is ROIC, and the B is reinvestment rate, and the PE0 is initial PE ratio, and the PE terminal is the terminal PE ratio. And the big capital T is holding period in terms of years. So this total price multiple equals to two parts. One is 1 plus RB to the power of T, representing the cumulative growth in earning. And the second part, PET, terminal PE over PE0, initial PE, represents the change in valuation. So what are the take-home information from this equation? First of all, the first part, ROIC and the investment rate are the key. If they are big to the power of T, you will grow exponentially, right? And the second, you do need a T. You can have a great company with a great ROIC reinvestment rate, but you sell it half years after you buy it, or 1 year after you buy it. You will not get 100 baggers, not even 10 baggers. You need time to compound that. You have to buy cheap because PE0 is at the denominator. If you make a denominator very small, you buy at a very cheap price. You will increase the total return. PET is the terminal PE, which means that you have to sell when the market is very excited about it. there's something called Davis double play, which means the earning is increasing and the PE is increasing. Simultaneously, you want that to happen. So the earning increase corresponds to the first part of the equation on the right-hand side, and the PE increase corresponds to the second part of the equation on the right-hand side. And I do you a favor, the annualized price return, the equation is here. You can play with it, plug in, and compare it when you select the company. Of course, this is only a very simple equation. You have to do your own study, your own judgment. This is not a magical 100-bagger finder. Finally, what's the catch? What's the real-world risk? First of all, you have to think about the size of the addressable market. With this simple model, if you say, I hold it for 100 years, that will grow exponentially to a very, very large number. Maybe, eventually the capital market is higher than the global economy. But that will not happen because every company has addressable market. You have to think, if this company grow, will there be a market that is large enough to hold this company? So you have to think within 10 years or 20 years, how large the market will grow, right? The second part is the mode of the company. If this company is very profitable, it's very natural that other companies will do the same thing. So what's the mode? Mode question essentially say, I have this size the market, right? For example, $3 trillion market. What fraction can my company hold it? Instead of being, taken away. You need a mode company. And also you have to worry about the dilution. Okay, your company grow, ROIC great, reinvestment great, but eventually they dilute a lot. The price of your stock are decreasing because your stock is holding a smaller fraction of the company. So it's a science because that's the equation. It's also an art, right? So you have to think both ways. Okay, you may think it's a very good valuation, system for selecting stocks, right? At least for the first step. What about those companies that is not yet profitable, which means their PE is negative? And a lot of those companies have a very big potential of going up. If you want to know more, subscribe, leave a comment below. If I see a lot of comments of interest, I will make a video about that. How to, find the 100 baggers for the company that is not profitable yet. I'm Professor Wang. I'll see you next time.